Again, apologies for the topic that's at hand today, but it's one of those things you do need to cover. It's part of life, I guess. All right, so what you're looking at here is a chart that covers mortgage under insurance claims, and this is a policy that covers your insurance and your mortgage in case of an early death of a family member that is on the mortgage lease itself that's paying the bill. So this does not apply to a family member. It applies to the person who actually took the loan for the mortgage. So now for me and my wife, since we were the ones who took the mortgage out, it'd be in case of one of us were to die. So in that situation, this is the payment that would cover the rest of your mortgage. I'll use my house as an example. So the mortgage we took out for my home was $63,000, right? That was the mortgage that we had. And then the idea is that we're slowly paying off of that. I know my payments, like in the long run, if I were to just keep making my payments, I would pay, I think when we did a calculation like 2 weeks ago, it was like $240-some thousand for my house over 30 years because of the way that compound interest works. But the idea is that the bill itself in the bank would still show that we're slowly paying off the $63,000. That's the insane part. Now, let's say, so we're on a 30-year mortgage. That's what we have. And let's say, now we're already past, I've lived in the house since 2011, so we're already past the 5-year point. So let's say year 10 in my mortgage, I were to pass away, right? Then the idea is that what the insurance company would do is they would look at how much is left on the mortgage, and that's what they're going to cover. So in a 30-year term, year 10, there was an unforeseen death, right? So the idea is that the insurance company will pay 84%. So that means you take your $63,000, you take it times 84%, which is 0.84, and this is the coverage that your insurance would write to the bank. They're not going to cut you a check. They're making out to the bank that covers the policy, right? Because you had to have had, when you take out your mortgage, the bank needs to know who your coverage is, who your insurance company is, because they're working closely together in case of situations like this, in this case. And so what they're doing is they're going to cover you. So 84%, so 0.84, we're going to take that times 63,000. And so in year 10, they're writing you a check for 52,000. Or I guess they're writing a check to the bank for $52,920. That's what's still left after 10 years. I want you to think about that just for a second. 10 years of mortgage payments, and your bill is only down about 11 grand. Okay? You're probably making on this house $600 payments, $600 every month, but look what happened. In 10 years, it only went down about 10, 11 grand because of that interest that's building in compound interest loans. Question?
So you don't subtract the 52 from the 63?
That's just the number I'm doing in my head to know like what I've already paid. Okay. This is what's still left of my mortgage.
So if someone dies,
yeah,
you have, what does a 10 mean?
The 10 is what year the death occurred on your mortgage payments.
Okay. And that means 84%.
84% of your mortgage is still left to be paid.
Oh.
It's still left, right? You've only paid, so if I subtract this number that, I've only paid up to this point in 10 years of making payments, I've only paid 11.
84%.
They cover 84%, which is 50 grand left of your mortgage. It's 84% of the mortgage still to be paid. And they'll just write you the check. Now, I know it's a sensitive subject. This applied in my life when my father passed. My father had a truck at the time. Bought a brand new Chevy about 2 years before he died from cancer. And the idea was that the truck was paid in full by the bank. Because on his policy for his truck when he bought it, he had, for some reason he's never done it before, he checked the box that said it had mortality insurance coverage. So he's never done that before. He just checked it off. I don't think he was actually paying attention to the policy he had. And he checked it off, and so that was covered. So in case of his death, the bank paid off, or the insurance company paid off the entire bill of the truck. So my mother owned it outright from that point on, because she wouldn't have been able to make that payment. And that's how it applied in my life. But again, this is for a mortgage as well. My parents already had their house paid off, so it didn't apply to them. So, but yeah, it's one of those things, like, I know it's a sensitive subject, but it's something that you will have to deal with at some point. It's nice to know your policies, to know what's covered, because in case of, like, let's say my death and my family, my wife would never be able to cover our mortgage by herself with all the bills that would come in. Because we have two separate banking accounts. I pay my car, she pays her car, we both pay the mortgage together. We pay separate bills separately to cover it, like I pay the cell phone bill and she pays groceries. Like, we just have this weird policy that we do, and it works for our family. But like, the mortgage is the last thing I ever want to have her left with. So it's one of those things, like, you do need to know those policies. It's important that you know what the coverage is going to be, because I don't want to ever stick her in that situation where she can't make that payment. So, all right. Now, here's the issue. Even though you're making the insurance company is making that payment for you, and they're paying off the rest of your house, you will still have to buy insurance for the house. You're going to still have to pay that. So that's something you need to think about. And also, the other thing you need to think about is you will still have to pay taxes on that home every year that you live there. And that's a huge number. My mother is still dealing with that right now, that she still has to pay the taxes on her home every year. And the taxes on a farm and acreage is actually crazy expensive. So it's one of those things that you just need to see it. All right, questions on this policy? Okay, let's do one more, just to get a feel for it. I'll let you guys pick any year term, and we'll pick a policy year, okay? That way you get a sense for it. So I'll give you a price of a home in just a second. So what type of mortgage? We want 20, over that was quick. 20-year mortgage. What year do we want to pick here? It's got to be anything less than, it's got to be less than 20. Because obviously 15, okay, let's go 15. And let's say the home we're buying is let's say it's a $125,000 home. 125,000. Okay. So, what's the number on my chart? If it's a 20-year mortgage and there was an unseemly death at the year 15.
41%.
So, yeah, 41%. So, let's see, your term, there was a death at year 15. Okay, so 41% coverage. That means you still owe 41% of your mortgage still. So they're gonna take the 125,000 and they're gonna take it times 41%. And so,
51,250.
say it again?
51,250.
A lot. Still owe 51,000 on the house. That's about half, so it makes sense. Okay, so that's the check that the insurance company would write. Now, it will take a while. You have to have a proof of death certificate from the hospital. You have to have a copy of the insurance. You have to have a copy of your mortgage. There's lots of paperwork you have to display to the bank, and then the insurance company takes care of it in the background. But it does take a while. You might have to make a payment or two before that kicks in, and then they'll pay you back the money that you overpaid. So it's one of those sad situations. You do have to deal with that. Question?
But the insurance pays them.
So,
Insurance pays for more than
What?
9%.
say it
What
again?
are you talking about?
So do they cover 41%?
Yeah,
Or
they're
are you
paying.
paying 41% of your mortgage?
They're paying the remainder of the 41% of the mortgage.
And you pay.
I've already paid up to this point 59% of it.
So they're paying less.
Because we're in year 15 out of the 20-year loan, I've already paid 59% of that loan.
Which is like that, in that example.
So in this example, the insurance company's writing you a check for 41%, that's this. You've already paid 125 minus 51. That's what you paid up to that point.
Oh,
Now, it seems crazy, because think about this, you picked year 15. Year 15 out of a 20-year loan, you still have 51,000, you're like, how is that even possible? It's only at about half, and you have 5 years to go, because the last remaining 5 years, you're paying straight coverage of the home, the principal. All the extra compound interest has already been paid. That's the first, if you see this, look at this. Up to this point, the first few years, you're just paying straight, interest. Because look at this, after 1 year of owning your home, you haven't paid any of it yet. Even though you've been making payments for a full year, you haven't even paid a single dime off the top of the price of the house yet. So when I bought my house in 2011, in 2012, in April of 2012, I haven't paid 1 cent of my mortgage yet. Until that year. And then after that, I start making slow chunks out of it. And you're seeing it there. Because you're paying straight interest until about, they say until about second, third year, you actually start making little payments on the principal, which is insane to me. That's why they make so much money off of the home loan. That's why banks want to give you a mortgage. They're making a ton of money off of you for doing it. It's better to save up your money and make a huge down payment. All right, questions at all about what we're doing here? Okay, homework is actually written on the board. You can see it over there. It's page 103. It's 1 through 10. It's due on Thursday. If you need to go grab a calculator, go grab one. Ken, I'm going to give you the homework problems here in a second. I'll put them up on the board for you. The chart is printed in your book. It's right next to the page you're working on. So you'll see it's that chart right there. Okay, it actually might be right above the homework, I believe.
Yours is on the board.
Right next to it. Right next to the homework.
It's in the-
So, that's true. They're gonna tell you what year the death occurred and what your actual mortgage was. And you're trying to calculate how much the bank is gonna get paid left from the insurance company. That's your, so it's a very easy number, just multiply and call it a day. All right, let me stop the camera, and then Cal will get you started on your assignment that you missed on Friday.
Cool beans.